Hello, everybody, and welcome. My name is Bennett Tchaikovsky. This is my Wiley solution walkthrough, Accounting Tools for Business. The authors of the textbook are Paul Kimmel, Jerry Weinget, and Jill Mitchell. This is for exercise 25-6. The question used in this presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are mine and not the authors of the textbook or of Wiley. Okay, so now you can all see me here. Let's go ahead, and before we thank that bus driver, let's come over here. So we've got BSU wants to purchase a new machine for $29,300, excluding $1,500 of installation. The old machine was purchased 5 years ago and had an expected economic life of 10 years with no salvage value. The old machine has a book value of $2,000 and BSU expects to sell it for that amount. The new machine will decrease operating costs for $7,000 of each year of its economic life. Straight line will be used for the new machine over the 6-year period with no salvage value. So the first thing we have to do is we're determining the cash payback period. But before we do that, what is the cost of our investment? Okay, so if I'm buying this new machine, right? So my new machine, the cost of the new machine is going to be $29,300. My installation costs are going to be right over here at $1,500. And let's do this as negatives. But now my positive is I'm going to basically old machine sell. And this is going to give me $2,000. So my net cash outflow of this, basically of the, is going to be $28,800. So that's how much I'm going to have to pay out today in terms of cash. Now, what it says here is very important. Okay, so it's going to decrease operating costs by $7,000 for each year of the next 6 years, and straight line will be used. Right. So first question is determine the cash payback period. Well, if you look back at exercise 25-2, and this is the video that took me 3 times to go through and make, had to go through this whole thing. But actually, if we're in this situation here, the payback period, even cash flow, is going to basically be my investment amount. And this is going to be divided by the annual return. So my investment amount is going to be the $28,800. I'm dividing this by 7,000. So my payback period is going to be over here 4. Right over here, 28,800 annual return. So my basically, this is the cash payback period. Okay. Now, the appropriate internal rate of return is what makes the net present value go to 0. And believe it or not, by going through and doing this one over here, we've also done the internal rate of return. This is also, it's the same formula. So right over here, our factor is going to be 4.114285. So what we do, right, is this is being paid out over 6 years. So we're going to go to the present value of an annuity of $1. We're going to go to 6 periods. And what we're looking for is we are looking for 4.11428. So let's go through and see it. We're at 6 periods and we want to see where we are. So we see over here, 4.11141. This over here is at 4.11428. So the approximate net present value is a little bit less than 12%, but it's right around 12%, because our number of 4.11 4 is slightly higher than 4.11141. So it's between just a little bit less than 12%. So our internal rate of return is what makes the net present value go to 0. So over here, determine the appropriate approximate IRR is approximately 12%. 6 periods. So right over here, this is 4.11141. So right over here, this is 4.11141. This is very close to this number here. So it's approximately 12%. Assuming the company has a required internal rate of return at 10%, state your conclusion, which should it be purchased? The answer is yes. Because if we go through and do this at 10%, we're going to have a positive net present value. So let's just go ahead and do it for fun. So if I take my annual cash flow of 7,000, if I go to the present value of an ordinary annuity of $1, we'll do 6 periods at 10% because that's the rate that the company wants us to do. 6 periods at 10% is 4. So right over here, if I multiply the 7,000 by here, I get 30,486.12. So my total so my net present value at 10% is going to be a positive 1,686. So if that's my required rate of return, we easily meet it, but we already knew it because the internal rate of return is approximately at 12%. So that is exercise 25-6. I want to thank you for joining me here today, and I look forward to seeing you on the next video. Have a great rest of your day. And thank you, Wiley. Have a good one.